Seema, I want to pivot a little bit and talk about something that certainly has been the focal point for global investors really since Friday, since we saw the inversion of the yield curve, the 3-month and the 10-year specifically. Goldman is out this morning and they're kind of downplaying the menace of the inverted yield curve. And we've got a chart up for our viewers. That blue turquoise line shows you where we've had recessions going back all the way to the 70s. The purple lines show the proportion of the curve inverted. And what we're seeing as of late, right now, it's not as high as we've seen in recessions of past. Is that a good point by Goldman? Do you agree that they make a good argument here?
Yeah, I think they do make a good argument. I mean, there's actually a whole host of reasons to not get too worried about this inversion. I mean, there's a signal there that we need to be cognizant of. But we also need to see the curve inverted for a longer time period. You know, one session is not enough. You're looking at almost a quarter before it matters. And also you need a deeper inversion than what we've been seeing and maybe spread across several curves. But I think what we did see is this inversion is not necessarily reflective just concerns about the US economy, but it's more reflective of concerns outside the US, mainly from Europe, as we saw from the economic data there, as well as, of course, you know, when we look at what the Fed has been indicating with regards to their hiking cycle being paused and maybe even cutting. These are all responses to that rather than necessarily a signal that recession is coming. And I think, you know, when you look at the economic data, when you look at what's happening in credit markets, none of that to me actually suggests that recession should be a real key concern in the way that markets have been pricing it in over the last few days.